Exodus from the East. U.S. banks retreat from China. The financial world is abuzz with news of a major shift. U.S. banks are pulling back from China, a move that has caught the attention of investors and analysts worldwide. For years, American financial institutions saw China as a land of opportunity, a vast market ripe for investment. The allure of tapping into the world's second-largest economy was irresistible. These banks established branches, formed partnerships, and poured billions into the Chinese market, hoping to capitalize on its rapid growth and burgeoning middle class. Now, the tide seems to be turning. The optimism that once fueled these investments is giving way to caution and reevaluation. Banks like JP Chase, Bank of America, and Goldman Sachs are reducing their exposure to the Chinese market. This strategic pullback is a response to a myriad of challenges. This withdrawal of capital, a stark reversal of fortune, has sent ripples of concern through both Wall Street and the halls of government. The implications are far-reaching. The retreat is not a sudden panic, but a calculated move. It reflects a growing unease with the risks associated with doing business in China, including regulatory hurdles and geopolitical tensions. It signals a growing unease with the risks associated with doing business in China. The regulatory environment has become more stringent, and the geopolitical landscape more volatile. While the reasons are complex, they point to a larger narrative of escalating tensions between the world's two largest economies. Trade wars, sanctions, and political disagreements have all played a part. The question on everyone's mind is, what does this mean for the future of US-China relations, and how will it impact the global economy? The answers remain uncertain, but the stakes are undeniably high. Cracks in the foundation. Why are US banks leaving? Several factors have contributed to the exodus of US banks from China. This trend has been growing over the past few years, and it's becoming increasingly noticeable. One major concern is the increasing regulatory burden imposed by Beijing. The Chinese government has introduced a slew of new regulations that US banks find challenging to comply with. China's government has tightened its grip on foreign businesses, making it harder for them to operate freely. These restrictions have made the business environment less welcoming for US banks. New data security laws and restrictions on cross-border data flows have raised alarms for US financial institutions, which rely heavily on data security and privacy. These laws are seen as a significant hurdle for banks that need to transfer data internationally. Adding to the apprehension is the escalating trade war between the US and China. The trade tensions have created a volatile environment that is difficult for banks to navigate. Tariffs and trade barriers have disrupted global supply chains and created uncertainty for businesses operating in both countries. This disruption has had a ripple effect, impacting various sectors, including banking. The tit-for-tat tariffs have hurt American companies operating in China, making the business environment increasingly unpredictable. Many businesses are finding it hard to plan for the future. This trade war, with no clear end in sight, has further fueled the anxieties of US banks, making them wary of further investments. The uncertainty has led many banks to reconsider their presence in China, opting instead to focus on more stable markets. A $1.7 trillion retaliation, Beijing's Treasury dump. China has not taken the US bank's retreat lying down. In response to the US actions, China has decided to take a bold step. In a move widely seen as retaliation, Beijing has started dumping its massive holdings of US Treasury bonds. This strategic decision is aimed at sending a clear message to the US. China is the second largest foreign holder of US debt, with an estimated $1.7 trillion in Treasury securities. This makes their actions particularly impactful. By selling off these bonds, China aims to put pressure on the US economy and gain leverage in the ongoing trade dispute. This move is seen as a way to counteract US policies that have been unfavorable to China. The move has sent shockwaves through global financial markets. Investors around the world are closely watching the situation, as the implications could be far-reaching. A sudden influx of US Treasury bonds into the market could drive up interest rates, making it more expensive for the US government to borrow money. This could lead to higher costs for businesses and consumers alike. This could have a ripple effect throughout the US economy, potentially slowing down economic growth. The increased borrowing costs could lead to reduced spending and investment, affecting everything from small businesses to large corporations. Section 4. Ripples in the UN economic fallout for China. While China's Treasury dump is intended to pressure the US, it's not without risks for Beijing. Selling off US Treasury bonds could weaken the value of the Chinese yuan. This is because selling dollar-denominated assets like US Treasuries increases the supply of yuan in the market, potentially leading to its depreciation. A weaker yuan could make it more expensive for Chinese companies to import goods and services from abroad, potentially fueling inflation. It could also make it harder for Chinese companies to repay their dollar-denominated debts, increasing the risk of defaults. China's actions, while seemingly retaliatory, carry significant economic risks for its own financial stability. Section 5. Uncle Sam's Debt Dilemma. Implications for the U.S. economy. The U.S. economy is not immune to the fallout of China's actions. While a sudden spike in interest rates is unlikely, a gradual increase could still have a significant impact. Higher interest rates could make it more expensive for businesses to invest and for consumers to borrow money, potentially slowing down economic growth. Furthermore, China's decision to dump U.S. Treasuries highlights a growing vulnerability for the U.S. economy, its dependence on foreign borrowing. The U.S. has run large budget deficits for years, relying on foreign countries like China to finance its debt. If China continues to reduce its holdings of U.S. debt, the U.S. may have to find other buyers, potentially at a higher cost. Section 6. Global shockwaves. The world watches and waits. The escalating tensions between the U.S. and China are being closely watched by the rest of the world. The interconnected nature of the global economy means that any major disruption in the relationship between the world's two largest economies has the potential to send shockwaves across the globe. Emerging markets, in particular, are vulnerable to spillover effects. A slowdown in the U.S. or Chinese economy could have a domino effect, leading to reduced demand for commodities and manufactured goods from developing countries. This uncertainty has cast a long shadow over the global economic outlook. Section 7. A future adrift. Uncertainty reigns in U.S.-China relations. The withdrawal of U.S. banks from China and Beijing's subsequent retaliation mark a new chapter in the complex relationship between the two superpowers. The future remains uncertain, but one thing is clear. The era of unfettered globalization and cooperation is over. The world is moving towards a new era of strategic competition, where economic and geopolitical interests are increasingly intertwined. As both countries navigate this new reality, the stakes are high, not just for the US and China, but for the entire world. The decisions made in Washington and Beijing in the coming months and years will have far-reaching consequences, shaping the global order for decades to come.